Liz, if you think about the risk investors are facing as they look further out on the curve, on one hand, investors have been wanting the Treasury to manage this duration risk. On the other hand, for them, 30 years out is a long time.
Right. I mean, that's the thing. As an investor, like if things go bad and there's a flight to safety to treasuries, that long duration means prices will gain a lot quicker, right? So it's a good thing. But like you said, the risk is that if things go sideways, we do have yields up a little bit today, so people who bought yesterday are a little bit underwater. You feel the more pain. So it's a little precarious spot, the 30-year, since it's such long duration. But so far, the other auctions have gone well. So that's a positive looking into it.
Let's even talk shorter duration here, 10 years rather than 30 years. If you pull up a chart here of just 3 days of a move in the 10-year yield, it has drifted higher. You're looking at it at around 415, which means if you bought into the auction yesterday, to the point you made to me earlier, you're underwater already. How much risk is there when you're looking at the 10-year, when that has been something that investors have increasingly been pitching since the end of last year?
Right. This is the tough thing. Let's talk about broadly why we have these yields going up is because we've had this concerted effort pushback, starting with Chairman Bernanke, I'm dating myself, Chairman Powell last week from the Fed and other Fed officials saying, hey, slow down. We're going to cut rates this year, but maybe not so fast. So, market is kind of pushing back when the cuts come, and that's kind of lifted yields for Treasury. So like you said, that 10-year, which saw a good reception yesterday at the auction, those rates are higher, so you're underwater. That's not good. I think investors have been saying, yeah, this is the year, like we should still buy bonds this year. It's going to be better. The worst of everything is over, but we're not seeing it yet. So people don't like to be underwater, right? So people have to kind of stay the course or they'll start bailing out. So I think the 30-year auction, if it does go well, it usually does tail, meaning the rate comes higher than at the 1 p.m. auction time. But if it's a large tail, that's not going to be received well. So I think we're going to see more yield increase. So let's just see how it goes. Again, some are saying it should go fairly decently, but we won't know until a little bit after 1 o'clock.
Liz, when I look at even the shorter end of the curve here, how much volatility there's been, you are very close to a coin toss for even a May rate cut at this point. When you talk to your sources and bond traders really across the globe, how much are those expectations burning their current wagers?
Yeah, I think they don't like it. They're kind of trying to say, well, if I look to the whole year, I feel pretty good. I think, we're still going to get some cuts, so I can take the pain. But yeah, we came into this year and they're thinking gung-ho. There was, over 50% chance at one point early in the year that we would cut. They thought the Fed would cut in March, right? So it's not helping, Shanali. It doesn't make people feel good to be underwater. But I think, you have a lot of big macro funds that are longer term that are saying, look what happened last year. It was brutal. And then the last 2 months of the year was a huge rally. So I think they are trying to say, staying the course, the worst of inflation is over. The Fed has to start easing at least by mid-year. I'll be okay by the end. But the jury's out, right?